Today we have the pleasure of interviewing Michael Oliver of Momentum Structural Analysis. How you doing today, Michael?
I'm doing well, Daryl. How are you?
Doing good, doing good. You're one of the most trusted voices in this space, especially a lot of your calls have been on point with silver and many of the other equities. I mean, the Brazilian equities, I mean, they started breaking out as well. And so you're a voice that I think is very important and people want to hear. So I'm just curious how are you viewing last week's action on a momentum basis?
Yeah. Well, when you look at short-term stuff, which is basically what that was, in other words, when we broke down, really it was one day. Think about it. It was Friday, and then we got a minor follow-through today, but basically one day. When you look at long-term trend factors, technical stuff we look at, momentum, it was merely a storm without breaking anything. And there's no structure it broke, no trend. It didn't even jeopardize. Frankly, there are no real developed momentum, what we call momentum trend structures, that are anywhere nearby. And normally, and I'd say normally almost 90% of the time, whenever a market makes a top of significance and lasting, or a bottom, you'll be able to look at a momentum chart, like a long-term momentum chart, where you measure price, let's say, oscillated in relation to a 3-year average, or oscillated in relation to a 3-quarter average, or something fairly long-term. You'll see structure on the momentum chart that says, oh gosh, there's a line, I better not break. And almost always, when a top is made or a bottom is made, you'll find that the breakage occurs not very far in time or price from the high or the low. This occurred, for example, 2011. We peaked in September, I think it was. We turned major bearish in December and then in January 2012. Okay, a couple of months off the high, a couple $100. And in fact, it labored for another year before it really fell apart. That's gold I'm talking about. Mm-hmm. And but the structure was, if you looked at the momentum chart, you'd say, good grief, any idiot could draw that line. But it wasn't evident on a price chart, but it was a momentum. Same with the bottom. 2015, after the 50% bear market, gold bottomed. And when you looked at the annual momentum chart, not the gold price chart, it kept just staircasing down a little bit. It slowed up. But you looked at the momentum chart, there was a chart pattern there that you said, good grief, look at that ceiling. It's 3 years wide. You keep going the same level. When you broke through, it was February 2016, mere $90 off the price low and 2 months after the price low. Whereas when we look at the charts now, gold or silver, and run any long-term study, there's no nearby momentum trend structure to even break. Mm. And so we think it is merely a violent jiggle in the middle, and I suspect it won't take a long time to recoup from it, meaning you might be in new highs next month or so. The issue is to see if it continues right now or not. And you start with today. Let's check it out, see what's happening. Get through the next day, then the next day. If all of a sudden you start oozing back up into that range, then you can wipe your brow, and it was a one-day phenomenon, really. Anyway, that's what we see there. And no, we did not call that break, and there's a reason. But we run very short-term momentum charts, like day-to-day action, which is what everybody seems to be preoccupied with. We saw a trend structure that broke Friday, early morning, and said, oh, I'm going to go down. But you'd had those same type of breakage points when you run the short-term momentum that occurred every couple of months. And usually the consequence is, oh, you get a bad day, you dust yourself off, and then you're back up again. This one was different. Not because of anything big it broke, but it broke daily structures, which meant, short-term. But it was deep. So, no, we did not anticipate the depth whatsoever. And we don't want to cry out to our subscribers all the time every time we see a little twitch that says, oh, we're going to drop for a day or two. Because then you scare everybody out of the market. But anyway, right now our assessment is wipe your brow. It's probably a one-day phenomenon. It didn't break anything. It's just noise in a very thin atmosphere. And I don't think it's an indication of sustained downside.
Yeah. Yeah, thanks for sharing that. So, I mean, obviously the move downward, I think it was for silver, it was a historical move. Like it was the most it's ever moved in a day. I think since the 80s or something of that nature. I'm curious so there's a lot of different theories as to why this happened. Some people are saying like, oh, it's the banks. Some people are saying like it's the fund managers who have to rebalance their portfolios by February. Some people say it's the Iran thing. There's so many different narratives out there, right? And so like
every day there's all that stuff out there.
Yeah. And so I'm just kind of curious, many people have been calling for triple digit silver for a while, and we've hit that, and so that's a huge milestone. Some folks are kind of wondering, like, okay, is this the top? Was this the top? Did I miss my opportunity to sell? Obviously, silver came down to 75. I mean, it was at close to 120. And so I think that's probably the question that's on a lot of people's mind was, did I miss my opportunity to sell? Was this a 2011 where it hit 48 and then didn't rebound for a number of years? And so just curious in your perspective there.
Yeah, well, it was confined for half a century in a range from $4 to 50, okay, back and forth. That's where you're going to stay, man. Meanwhile, gold had blown out the 1980 high in 2011. Silver didn't. And then it blew out the 2011 high, coming up through 1920 a couple years ago. And boom, boom, massive gains. You could even look at a chart of copper. Don't laugh. It stayed in a range from the 70s, 80s, 90s to about late 2005. Copper was selling for 50 cents a pound to $1.50, 50 cents a pound to $1.50, like silver was for 50 years in a $4 to 50 range. Okay, copper was in a similar old reality. This is 2005 now. We're going back. Late 2005, copper finally broke up out of that range. Took it a couple months to struggle, but definitively you could say, okay, finally it's up out of that range. Within a couple quarters, it quadrupled in price up to $4 plus, from 50 cents to $1.50. And then, there were sell-offs after that, but it didn't come back to 50 cents or $1. It had a range of, average price probably $3.50 or $4. Like 4 times the height of the prior 50 year. Lead did the same thing in 2007. How come silver is supposed to stay in its half-century range when nothing else has? Okay, so it finally broke out. And if we look at the copper and the lead charts back in 2005 or lead 2007, when it broke out, within several quarters, you quadrupled the price. And it wasn't like a broad base metal explosion. It was copper, and then a year and a half later, it was lead. And then when you look at gold, repeated massive new highs. And silver is contained. Well, there's some explanations as to why that mistake has occurred. But when markets make pricing mistakes, they get into a range, let's say excessively too high for too long, like a stock market bubble, for example. When they go down, they often go way more than to correct for that. If they should drop 50, they go 80% down, like NASDAQ did in 2002. Why should silver stay confined in the $50 range? Well, it broke out. And here's 2 simple methods of determining, where might you go? If you look at an arithmetic chart, which is what people punch up on their screen, dollar on the side, dollars on the side, but not logarithmic or ratio scale. You see this $4 to 50, $4 to 50. You broke out, but when you measure the thickness of that perfect rectangle and do the orthodox technical analysis thing, you got a range, call it $45, $5 to 50. We call it 0 to 50 if you want. Add 45 or $50 to $50, and that's your swing objective, the thickness of the prior range. Well, you'll remember back a few weeks ago, we had a struggle going on for a week or so in the low to mid 90s. In other words, there were a lot of sellers there saying, hey, we've met the arithmetic swing objective. I'm getting out. Okay. And then all of a sudden, boom, got 121. So it's evident now, okay, getting to 121 means the old arithmetic ratio or arithmetic swing objective was invalid. Okay. But when you put silver on a logarithmic scale chart, a ratio, and you measure the dimension of that 50 half-century range, from the bottom of that range to the top of that range was a 10-fold gain. Mm-hmm. If you bought silver $4 or $5 and it went to 50, $4 or $5 went to 50. Wow, 10-fold gain, back and forth. Okay, now look at the mama market, gold. During that same time, it had 8-fold gains, but they exceeded prior gains. They didn't stay capped. So if you look at each of the bull markets, like the peak in 1980, the peak in 2011, they were 8-fold multiples. And right now, by the way, gold's recent high is only a 5-fold multiple from the bear low. So it hasn't even matched those yet. But in the case of silver, if we do the ratio scale and do the same, well, what's the thickness of the range? Add it to it. It says $500. Don't laugh. Heck, if you know, maybe it's been restrained too long. Maybe it's way too cheap in relation to gold. That's a measurable fact. Maybe it's way too cheap in relation to its own reality. It's way too cheap in relation to the degradation of the money unit. Look at an M2 chart. Look at this growth decade by decade. If silver matched the 1980 high, I haven't done the math. I bet it's like $400 or $500 just to match.
Yeah.
1980. So talk about, was that the top? Even using simplistic methods, no. By going way beyond the arithmetic goal, it's saying, hey, maybe I'm going to the ratio scale goal. Well up in the 300, 400, 500 range. That's what we think is about to happen, and we think this is simply a midpoint gut kick, not a top.
Yeah. Yeah, I think, I'm always on social media just kind of engaging sentiment and such, and there's a lot of people that think that the chart just needs to go straight up, like the price needs to go straight up with no pullbacks or anything.
What world is that?
You know?
No.
So, yeah.
The other issue is, what's your point of entry? If you're not a trader now, okay, forget the trader. You know, he's in and out every week, so his reality is week to week, okay. But a guy who's an investor, our last two major buy signals for silver. Originally, back February 2016, we said gold's turning up and silver, that was the bottom for silver. Okay, fine. But since then, we gave a couple other entry points that we considered good investment grade entry points based on momentum breakouts of silver and based on its spread relationship to gold. In other words, when you plot silver month to month versus the price of gold, and you plot that chart, and what we do is we divide silver into gold, express it as a percent. So early last year, for example, silver was 1% of gold. Now it's up toward 2. Okay, nice move. But historically, if you go back a long way and plot that chart month by month, you'll see that for 10 years, there was a ceiling on that relationship at a very low level. And we cleared that in November. And when we cleared that and silver broke out versus gold, in other words, no longer the dog, I'm going to lead now. Okay, that's what silver said. That was $50.
Yeah. And
boom. Okay, what happened since? Okay, so if your entry level was back in June of last year, where we had our first buy at $34.79, or at that $50 level, yeah, you gave back some profits, but you didn't get anywhere close to your average entry price. So again, point of entry is very important, and it probably affects the way a lot of people are thinking about this right now.
Yeah. I mean, even the correction we had back in, what was it, October? I think, I had jumped back in and started buying silver at 45,
Yeah. Well, you were dumb, see? No, you weren't. That's right, it worked. You bought weakness. Admittedly, this is sharper than even we expected, but we did expect somewhere in the middle of this clock, and we set our clock as of the November close, meaning when that spread relationship of silver versus gold breaks out, such a clear structure, you'll get a gusher. And whenever that's happened before, usually it lasts a couple quarters, where silver has had its breakout. It says, whoosh, I'm going to regain some reality versus gold. We're only starting month 3 of what's likely to be a couple quarter explosion. And again, harken back to the copper move and the lead move I mentioned. When they broke through their old reality, a couple quarters later, quadrupled, So that's where I think we are. It's just, yes, it's scary. All we're looking for now is stabilization and some sign that we're coming up out of here, not going back to the highs. And that'll be a late issue. But somewhere in between here and there, we're going to come up with some numbers that says, oh, yeah, that was it. If you're not in, this is a good time to buy,
Yeah.